So, after posting my video on how to use an interest only mortgage to pay down your home much quicker or as an investment, um, I got a lot of feedback. People wanted to know more of the ins and outs of kind of how that works. So, let me try to give it a shot to explain it to you guys. So there are some requirements. You do have to have a 720 credit score. They do prefer somebody to be under 40% DTI or debt to income ratio. But aside from that, as long as you have assets that are non-qualified, meaning taxable assets, not IRA or 401k assets, that they can put or hypothecate or put a pledge on it, a lien, whatever you want to call it, on the assets. That way you don't have to actually use your money to put down the 20%, so that you don't have to pay prime and mortgage insurance, also known as PMI. This helps you bypass all of that while keeping your assets invested in the market, and so they grow while you're still paying. While you're still, I guess, meeting the regulatory requirements for the 20% down. Now, that's one of the big benefits. Now, on the downside, if those holdings do go below that 20% threshold that would have been needed to hypothecate that 20% down payment on a house. So let's use a simple math. If it was a $500,000 house, 20% is 100,000. Let's say you had 120,000 in investable assets, and the market went down. Now you only have 99,000. Then they would do what's called a call, or they would call your collateral. They would either ask you to deposit more money into the account, or they would ask you to sell some of it to cover the portion that you're missing. So if that makes any sense. But anyway, now I'm going to talk more about the actual process of what I was talking about in terms of the amortization table and how you pay down the house quicker than you would with a 30-year mortgage or a 15-year mortgage or any other type of mortgage aside from paying it cash. Buying a house cash is not highly recommended, given that if you're a qualified buyer, you get a much lower interest rate than you would if you left the money invested. And even if you invested in the S&P, you'd still average out about 7.5%, which is better than what you'd get on the mortgage loan. So you'd still be a net positive. So the way this works is you get those that 20% in assets that you have. You hypothecate them. You can do it through Bank of America, for example. So then they would put a pledge on those $100,000. Let's say, like I said, you're buying a $500,000 home. Now, the cool thing is your payment would only be the interest of that, $500,000 loan. Now, since you satisfied that 20%, you don't have PMI, which is the primary mortgage insurance, which would go away when you pay down 70% of the mortgage anyway. But since we're using this method, you're going to get to that 70% value fairly quickly. So what I mean is, what we would be looking to do is to amortize the mortgage ourselves. So you borrow the 500,000. You calculate what that monthly payment would be on a 30-year mortgage, which would be drastically higher than if it would be on an interest-only mortgage, since the interest-only mortgage is just the interest. So it might be a $400 payment that you have to make every month, but that does not pay your principal down at all. So what you would do is, when you calculate that 30-year mortgage payment, that could come out to $2,200 or whatever. But if you had done a 30-year mortgage, about $2,800 of that, if not more, goes to the interest, and the other $250 or whatever, $100, will go towards the principal of your home. This is where the scam happens. Banks know that the average person in the United States moves anywhere between 8 to 12 years. They don't stay in a residence longer than that for the most part, per the current statistics. It's not like it used to be, when people actually purchase their homes to live in them and stay in them, and pass them down generationally. So that leads me to the point of, when you get that 7/1 interest only mortgage, you also don't put anything down, because you're hypothecating the taxable asset that you have. So as of right now, you're basically haven't paid anything for the house. Then if you're a first-time home owner, I would encourage you to apply to those first-time homeowner programs that they have where you take a class and they give you 7,500. You can also go to the builder and they could add, and you can get a bunch of different things. Like when I bought my first house, they paid for me to get the marble, the nice marble on the counters, or they could pay for the hardwood floor. They gave me $23,000 just for building a new home, and that was because I was as a first time home buyer, as well as they gave me the first time home buyer money, the $7,500. So all in all, it was great. So how does this work? Most mortgages, 30-year mortgages, it takes roughly about 22 to 23 years before you pay more towards principal of the home than towards interest. For those first 20 plus some years, you're paying all interest. And the mortgage companies know this because they know that in 8 to 10 years you're going to sell that house, and you're practically only going to pocket whatever the house appreciated, not because you paid down the mortgage. While the way that I'm doing it is, now we're flipping it on its head. That minimum payment of $200 that you had to make for just the interest only payment, that is your fixed payment that you have to pay every month. But say you're making the full 30-year amortized payment, that payment could be $2,100. So now you're paying $1,800 towards the home's principal, right? The other cool thing about buying a house this way is, say you run into financial trouble, your required payment is only that $200, whatever the required interest payment is. So if you don't feel like making the full payment for a specific month, you don't have to. Let's say it's Christmas, expenses come up, whatever the case is, you don't have to make that payment. You just have to make that minimum $200-300 payment, whatever the interest is. So that's just another benefit to doing that. But the cool thing is, when you add up the numbers, it takes, like I said, it takes about 22.8 years or so for you to pay more towards the principal. Well, guess what? Now you can pay that whole house off in 7.2 years because you're off the rip paying a lot more towards the principal of the home than towards the interest of the home, if that makes any sense. So you guys, get smart about all these programs and all these different things that are available to you to buy a house, especially as a first-time home buyer. But even if you're not a first-time home buyer and you're somebody that's somewhat affluent, middle class, has some taxable savings, that doesn't mean IRAs, it doesn't mean 401ks, 403bs, 457s, none of that. It's only taxable money, meaning money that you pay taxes on if there are gains. So just wanted to give you guys a more in-depth kind of overview of how you go about buying a house with the interest only mortgage. If you have any more questions like you did already, DM me and I can go into more detail as to how you go about doing this. But usually this is reserved for the wealthy, but it's not just for the wealthy. Anybody can use it as long as they meet the criteria. So I encourage you guys to, get educated and find out, what is the best way for you to buy a house. And don't just stick to what your grandpa, your mom, and everybody else is doing with their 30-year mortgages that, they sell after 10 years and, think they made a lot of money because the house appreciated. Well, if you do it my way, the house not only appreciates, but the value of your, how much you owe also goes down. There's also another aspect to this that's called factoring, where most non-jumbo loans get, bought and sold by CMOs or collateralized mortgage obligations, which is how 2008 happened, but that's a video for another day. JML's Productions, you heard it first.